Welcome back to the Daily Economy 24/7. It is Saturday, and that means one thing: your full-length, cinematic, data-rich Saturday economic wrap. Today we are going deeper than the headlines. Deeper than the tickers. Deeper than the surface-level narratives. We are going to walk through the markets like a guided tour, from Wall Street to Frankfurt, from Tokyo to Hong Kong, from oil rigs to bond desks. And we are going to explore the emotional and economic forces shaping the week. This is not just a recap. This is a story. A pulse check. A moment to understand where the economy stands as we head into the weekend. Let us begin. Let us start where the world always looks first, the United States. Today's market session was the kind of day that tells you everything without shouting. A day where the numbers move, but the mood matters more. Here is how the major indices finished. Dow Jones, 48,731.16, plus 288.75, plus 0.60%. S&P 500 to 6,932.05, plus 22.26, plus 0.32%. Nasdaq, 23,613.31, plus 51.46, plus 0.22%. The Dow led the way, not because investors were euphoric, but because they were defensive. Industrials, healthcare, and utilities carried the load. The S&P 500 held steady, balancing strength in energy with weakness in consumer discretionary. The Nasdaq lagged slightly as traders took profits in megacap tech, a sign that investors are not abandoning tech, but they are trimming risk. The mood on the trading floor: if you were standing on the floor of the New York Stock Exchange today, you would have felt it. That quiet hum of uncertainty. Not fear. Not panic. Just hesitation. Traders were glued to screens, watching bond yields, watching oil, watching the dollar, watching every whisper from the Federal Reserve. It was a day where nobody wanted to make the wrong move heading into the weekend. Sector breakdown: the story beneath the surface. Energy. Up, driven by rising crude prices. Healthcare. Up, benefiting from defensive rotation. Utilities. Up, classic risk-off positioning. Consumer discretionary. Down, reflecting household tightening. Tech. Mixed, with profit-taking in mega caps. This is the kind of sector rotation you see when investors are preparing for a slower economic environment. Markets are emotional creatures. They respond to fear, hope, uncertainty, and momentum. Today's session was defined by caution. Investors are waiting for next week's inflation data, the Federal Reserve's tone, early earnings signals, consumer spending patterns, holiday season revisions, updated guidance from major retailers. The market is not running away from risk, but it is not chasing it either. It is standing still, listening, watching, waiting. Now let us talk about the economic data that shaped this mood. Yesterday's economic releases were like a weather report for the economy, not stormy, but cloudy with a chance of tightening. Labor market. Cracks beneath the surface. Initial jobless claims, 214,000. Continuing claims, 1.923 million. Initial claims remain low, a sign that layoffs are not accelerating dramatically. But continuing claims tell a different story. More people are staying on unemployment longer. That means it is getting harder to find new jobs. That means the labor market is cooling. Housing and mortgages. The freeze continues. MBA mortgage applications fell 5.0%. Higher rates are still weighing on demand. Refinancing is nearly non-existent. Purchase applications are soft. The housing market is not collapsing, it is freezing. Inflation, cooling, but not cold. CPI-YoY, 2.7%. Core CPI-YoY, 2.6%. Inflation is easing, but not fast enough to give the Federal Reserve total comfort. The Fed wants inflation closer to 2%. We are not there yet. GDP for Q3 was revised to 4.3%. That is strong. But it is backward-looking. Forward indicators, consumer spending, business investment, hiring, are softer. The economy is not in trouble. But it is slowing. And markets know it. Now let us take a trip around the world. Global markets today were like a mosaic, each region telling its own story. DAX, Germany, 24,340.06, plus 56.09. FTSE 100, UK, 9,870.68, minus 18.54. Germany saw modest gains, driven by industrials and exporters. The United Kingdom slipped as inflation expectations ticked higher. Europe is walking a tightrope, sluggish growth, persistent inflation, weak consumer spending, energy uncertainty, political tension. Investors are cautious. Asia, the big movers. Nikkei, Japan, 49,620.18, plus 618.68. Hang Seng, Hong Kong, 25,690.54, plus 192.40. Japan surged on tech strength and a weaker yen. Hong Kong gained but remains under pressure from soft consumer spending and property sector concerns. Asia is a region of contrasts. Japan is booming. China is struggling. South Korea and Taiwan are riding semiconductor optimism. Emerging markets saw weaker currencies, higher bond yields, lower risk appetite. Investors are pulling back from riskier assets as global uncertainty increases. If the United States was cautious today, global markets were uneasy. Slowing demand, sticky inflation, geopolitical tensions, currency volatility. The world is not in crisis, but it is not comfortable either. Now let us talk about commodities. Commodities told their own story today, a story of supply, demand, and uncertainty. Oil prices rose as traders anticipated tighter supply heading into the new year. Energy markets are watching OPEC production, U.S. shale output, global demand forecasts, geopolitical tensions. Oil is not spiking, but it is firm. Natural gas prices slipped on mild weather forecasts and higher storage levels. This is a seasonal story, a weather story, a demand story. Gold held steady as investors sought protection against uncertainty. Gold is not rallying, but it is not falling either. It is sitting quietly, waiting for the next macro signal. Copper and aluminum were mixed, reflecting the uneven global manufacturing outlook. Manufacturing is not collapsing, but it is not accelerating. Now let us talk about currencies and bonds. The dollar strengthened today as investors moved toward safety. Currencies, the euro weakened on soft economic data. The British pound slipped on inflation concerns. The yen fell as Japan maintained its ultra-loose monetary stance. This was a classic risk-off currency session. Treasury yields dipped slightly as investors rotated into safer assets. The two-year yield moved lower, reflecting expectations that the Federal Reserve may need to cut rates sooner if the slowdown deepens. Bond traders are not predicting recession, but they are preparing for slower growth. Now let us bring it all together. So what does all of this mean? Today's markets were not chaotic. They were not euphoric. They were uncertain. Investors are waiting for clarity. Households are tightening. Businesses are adjusting. Communities are feeling the pressure. The market is not predicting a crisis, but it is preparing for a slower, more cautious economic environment. Next week's data will be critical: inflation, consumer spending, manufacturing, employment. The story is still unfolding, and we will be here to cover it. This has been your full-length Friday economic wrap on the Daily Economy 24/7. We covered the United States. We covered global markets. We covered commodities, currencies, bonds, and the big picture. As always, stay informed, stay aware, and stay ahead. Have a great weekend.